Santam, yep, the leading player. I think it's got about 20% market share, controlled by Sanlam. Okay, so Santam, the yellow umbrella crowd, that's 68 or something percent owned by Sanlam, the global life insurer and asset aggregator. Market capitalization of Santam, though, 26.3 billion rand. Price earnings ratio of 14.9, dividend yield of 3.35. So Lance, talk to me about their business model. I mean, they invented the idea of the sort of multiplex type thing where you had both your car and some of the other stuff. But very solid, very sound, very well run, big player in the corporate insurance market. That's, you know, farmers and businesses and that kind of thing.
So certainly, most probably the most developed of the South African short-term insurers. It's a bit of an short-term insurance conglomerate that has actually been developed there, because it's got about 5 different businesses within that. So it's worth quickly talking about those.
Okay, go for
they
it.
have the corporate commercial and personal lines business. That's sort of one grouping.
Okay.
They have the niche businesses, which are very, very strong in unusual. Crop insurance is one of them, but aviation is another. So there's several.
Where you get specialist risk assessors and
they've bought up underwriting managers over the years. Marine is another one. So very strong in that, and they report those separately. They've got My Way, which is the direct insurer in the mix.
That's specifically so that they can compete with themselves for people who like doing the direct model. Yeah.
And their view is the shareholder needs to have access to the direct market in terms of owning into Santam, because that is a alternative distribution model which is very viable, as we've seen in the market. And we'll talk more about the pure plays later in that respect. And then they've got Santam Re, which is a reinsurer which they're developing. And
one level back.
Exactly. And quite cleverly what they're doing is internally they'll gather up some of their own reinsurance. So it's a little bit of vertical integration, and then looking for opportunities around the world. Quite a competitive market, but they think they have the expertise and knowledge just to add to the mix. So in owning Santam, you're actually getting a nice spread of short-term insurance assets.
Well, let's look at the share price, because what I will just point out is most of the money comes from managing the assets that they aggregate and gather. And clearly, you can see the underlying value of the business has risen. A little bit choppy, which is a reflection, I guess, of the fact that occasionally you might have a little bit of an underwriting problem if there's lots of hailstones and that sort of thing.
Yes.
But for a long-term shareholder who's prepared to be patient, this thing looks very good.
Yes, and what's worth talking about is the total return of these businesses is quite different from the graph that you put up there. Because
why is that? Payouts.
They pay, so there's 2 parts to it. Dividends are often not reflected in pure price graphs, which is what we're looking at here. But then on top of that, for Santam in particular, is special dividends. And Santam has a very, very strong history of paying out special dividends. Their capital management is very good. And under Ian Kirk, who now, of course, is the CEO of Sanlam, exactly, the parent company, he really looked very carefully at the capital management of the business and made that very, very efficient. So what you're seeing is they have quite a good discipline of their solvency ratio, which is really the capital and the premiums, the ratio. And they say their target is 35 to 45, and generally when it gets over 45, they pay a special dividend.
Okay, but there's no ways you would know if you were not a specialist following the sector when they were about to pay one of those. You just got to be holding on and hoping that every now and then you're going to get a bit of a dosh of the lolly.
Although I think you have quite a good indicator. They're very good in that 35 to 45% level. So when they start going over 45, then the chance...
You can expect something.
Yes, exactly. You can expect something.
Okay, so we like this space. We think these companies are well run. You mentioned management. The new CEO is Lizée Lamprechts. I think she was in the business for a long time, but everybody seems to like her very much.
Yes.
Does the fact that Sanlam has a big stake make any difference? There's enough liquidity for people to buy the shares in the ordinary market?
The liquidity has improved because it's quite attractive as an investment vehicle. And they recently had a BE placing where they unlocked their BE scheme from about 9 years ago, and they placed the shares pretty easily. And that was a liquidity event to actually buy in, is what a broker told me. Quite interesting, because the liquidity is okay,
fair,
but it is quite tightly held because of the big Sanlam shareholding. Of course, that provides a huge underpin to the actual stock itself, because if it ever got too cheap, Sanlam would make an offer to buy the business. And they have tried, not recently, but 2 or 3 times years ago.
Okay, but here's the thing. We talk hot stocks, not stocks. I mean, this sounds like a very solid performer, but is there something that lies ahead in the next 6 months, which is an obvious catalyst for a sharp re-rating of this stock upwards, or is it just sort of business as usual?
No, there's no catalyst.
Plus, it must be asked, if the market is having a rough patch now, as we know it is there not some sense that perhaps at some level the aggregate value of their investments and their investment returns are going to be somewhat muted in the next reporting period?
So it's worth quickly talking about the business model. You have the underwriting side of the business, which is premiums less claims and costs to get the assets, and that's one side of the business. And the other side is, of course, the returns on the free float, which is the premium they're holding, which they may have to pay for claims. Invariably, they will pay, but hopefully not all of it. So you've got sort of 2 businesses in there, a return on capital business and an insurance business. And yes, market returns do affect the other side, the return on capital business.
Just a question about their investment returns. Do they manage all that stuff themselves, or do they place some of that capital, their statutory and other float capital, with third-party asset
managers? Yes, they do.
Because I remember when we discussed some of these other groups, some of them have got very conservative policies, lots of bonds, others are a little bit more exciting with some equity exposure, but of course that works out better or worse in different points in the cycle.
Yes, so what you have are more volatile earnings because of if you place more in the market, the equity market, you're obviously going to have more volatile returns. But in the long term, you'll most probably have better returns.
Yes,
so if you want very smooth returns, buy a bond. But if you want good returns, which are maybe a little bit choppy, buy a short-term insurance company.
Right, so we're going hot or not on this one?
Hot on this one.
Hot. Okay, good. I'll go hot too.